Hello and welcome back. This is your host Harshit Sinha, continuing with the series on investing in ESG with another interesting topic on ESG sustainable investment strategy for India. Sustainable investing is an approach that considers environmental, social, and governance, that is ESG factors in investment decision and portfolio management. It aims to generate long-term competitive financial return while also promoting positive societal impact and addressing global challenges. Looking the principle of investment in ESG, investors scrutinize a company's environmental policies and practice to determine their sustainability and potential risks associated with the environmental degradation. Further, the company that prioritize the social responsibilities are seen as more sustainable because they contribute to the well-being of the society. Equally, it has been noticed that effective governance is a critical as it ensures that companies are managed in the best interest of their stakeholders. Companies with a strong governance practice are generally better at managing risk and sizing opportunities, leading to more sustainable long-term growth. Overall, it is concluded that incorporating ESG factor into investment strategy is not just about the ethical consideration. It's a pragmatic approach to risk management and value creation. By prioritizing sustainability, investors can contribute to positive societal outcome while achieving solid finance return. As global awareness and regulatory support for ESG principles grow, sustainable investing is set to become an increasingly integral part of the financial landscape. Now let us explore how ESG is linked to explore sustainable investment strategies with sustainability themed investing, norm-based screening, negative exclusionary screening, positive best-in-class screening by incorporating corporate engagement and shareholders action and in exploring impact or community investing. Now let us take sustainability theme investing. The first is focused approach. Sustainability theme investing prioritizes the investment that contribute to environmental, social, and governance goals. This focused approaches involves selecting companies that actively addresses issues like climate change, resource scarcity, and social inequality. Investors look for the business with strong environmental policies, ethical labor practice, and robust governance structure. Companies that lead in sustainability tending to outperform their peers, providing attractive returns while minimizing risk. For example, MSCI ESG indices are designed to identify firms excelling in ESG criteria, making it easier for investors to target sustainable opportunity. The second is target impact. The primary goal of sustainability themed investing is to generate measurable positive impact. Investors are increasingly focusing on sectors such as renewable energy, sustainable agriculture, and green technology. These investments aims to reduce carbon footprint, conserve natural resources, and improve social outcome. For instance, the report of GRI shows that the impact investment can address global challenges such as poverty and environmental degradation while delivering financial return. By targeting specific ESG goals, investors can contribute to sustainable development and drive long-term societal benefit. Third is growing popularity. The popularity of sustainability theme investing is surging, driven by increasing awareness and demand for responsible investing. Institutional investors, asset managers, and retail investors are recognizing the long-term benefits of integrating ESG criteria into their portfolio. According to report by Morningstar, sustainable funds attract record inflow in recent years, reflecting a shift in investor preference. Moreover, regulatory frameworks such as the European Union Sustainable Finance Disclosure Regulation are pushing to greater transparency and accountability in ESG reporting, further boosting the appeal of sustainable investment. And so do SEBI does the same thing in India. In conclusion, sustainable themed investing with its focused approach and targeted impact is rapidly gaining traction among the investors. By aligning financial goals with ESG criteria, investors can achieve competitive returns while contributing to global sustainability efforts. As the popularity of this investment strategy grows, it promises to play a crucial role in addressing some of the world's pressing challenges. This slide discusses the norm-based screening. The first is screening criteria. Norm-based screening is an investment strategy that assesses potential investments against a specific international norm and standards. These norms are set by the reputable organizations such as United Nations, International Labour Organization, and Organization for Economic Cooperation and Development, that is OECD. The screening criteria including examining companies' adherence to human rights, labor rights, environmental protection, and anti-corruption measures. Companies that fails to meet these standards are excluded from investment portfolios. This approach ensures investments are aligned with the globally recognized ethical sustainability standards and promoting responsible business practice. The next is related to the ethical consideration. The primary aim to NBS is to prevent investments in companies that engage in unethical or harmful practice. This includes avoiding companies involved in human rights abuse, environmental degradation, corruption, and other forms of unethical behaviors. Ethical considerations are at the core of NBS, ensuring that investors do not support or profit from such activities. Beyond exclusion, norm-based screening, that is NBS, often involves active engagement with companies to encourage them to adhere to ethical norms and improve their practice. This proactive stance helps in driving positive changes within the industries, contributing to broader social and environmental benefits. The next is related to the alignment with values. Norm-based screening, a framework for investors to align their investment portfolio with their ethical values and principles. This alignment is crucial for individuals and institutions that want their investments to reflect their commitment to ethical standards and sustainable development. By incorporating NBS, investors can ensure that their financial activities support their broader ethical goals, such as promoting human rights, environmental sustainability, and good governance. This alignment not only enhances the ethical integrity of these investments, but also builds trust and credibility among the stakeholders who share similar values. Overall, norm-based screening is a powerful tool for responsible investing. By adhering to stringent screening criteria, focusing on ethical consideration, and ensuring alignment with personal value, NBS helps investors create portfolios that are both financially rewarding and ethically sound. This approach not only mitigates risk associated with unethical practice, but also contribute to positive societal and environmental impacts. Now we shall discuss negative exclusionary screening, that is NES. The first is related to the exclusion criteria. Negative exclusionary screening, that is NES, is an investment strategy that systematically excludes certain companies or industries from portfolios based on the specific ethical, moral, or environmental criteria. Common exclusion criteria includes involvement in activities such as tobacco production, weapon manufacturing, fossil fuel extraction, gambling, and human rights abuse. For instance, many socially responsible investment funds exclude companies involved in coal mining due to its significant environmental impact. This method ensures that investment do not support activities deemed harmful or unethical, thereby aligning with the investor's value and societal norm. The next is related to the value alignment. One of the primary motivations for utilizing NES is to align investment practices with personal or organization values. This strategy is particularly appealing to socially conscious investors who want their financial decisions to reflect their ethical belief. By excluding companies that engage in activities contrary to their values, investors can ensure that their portfolio supports positive social and environmental outcomes. For example, an investors who value environmental sustainability might exclude companies with poor environmental records. This alignment not only enhances the ethical integrity of the portfolio but also resonates with the stakeholder who prioritize corporate responsibility and sustainability together. Next is risk mitigations. Negative exclusion screening serve as a risk mitigation tool by avoiding investment in industries or companies prone to regulatory, reputational, and financial risks. Companies engaged in controversial activities are often subject to stricter regulations, legal liabilities, and public backlash, which can negatively impact their financial performance. By excluding such companies, investors can reduce exposure to these risks and enhance the stability and resilience of their portfolios. Additionally, these approaches can lead to a better long-term performance as companies with sustainable and ethical practice are more likely to thrive in evolving the market landscape that increasingly values corporate responsibility. Overall, negative exclusionary screening is a strategic approach to responsible investing that helps investors avoid companies and industries that do not align with their ethical values and pose significant risk. By adhering to clear exclusion criteria, align investments with the personal or organizational value, and mitigating associated risk, NES provides a robust framework for achieving both ethical and financial objectives. Now we shall discuss the positive or the best-in-class screening, that is PBC. The first is we will discuss about the approach. Positive best-in-class screening, that is PBC, is an investment strategy that environmental, social, and governance, that is ESG criteria relatively to their industry peer. This approach focuses on recognizing and rewarding companies that lead in sustainability practice that rather than merely avoiding those with poor records. PBC involves rigorous analysis and comparison within the sector to select the best performing companies, fostering a competitive environment that encourages continuous improvement in ESG standards. Next is related to criteria. The criteria for positive best-in-class screening vary depends upon the specific ESG factors deemed most relevant. Generally, these criteria include environmental impact such as carbon footprint and resource efficiency, social practices such as labor standard and community engagement, and governance issues including board diversity and corporate transparency. Companies are assessed on their overall ESG performance and specific metrics that reflects their leadership in sustainability. Tools like ESG rating agency and sustainability indices such as the Dow Jones Sustainability Index provide the valuable data to identify the top performers in each industries. The next is related to the objective. The primary objective of the positive or the best-in-class screening is to generate long-term financial returns while supporting companies that contribute positively to society and environment. By investing in leaders in ESG performance, This strategy aims to drive market transformation towards more sustainable business practice. It also aligns investor portfolio with their ethical values, allowing them to support corporate responsibility proactively. Additionally, companies excelling in ESG criteria often exhibit strong risk management and resilience, potentially leading to better financial performance and lower volatility in long terms. In conclusion, positive or the best in class screening is a proactive investment strategy that identifies and supports companies leading in ESG performance within their industries. By focusing on superior ESG criteria and aligning investments with the ethical values, this approach aims to achieve both financial returns and positive societal impact. This slide discusses about the corporate engagement and shareholder action, that is CAS. The corporate engagement and shareholder actions are pivotal in shaping responsible business practice and fostering sustainable growth. At its core, CAS involves shareholders, particularly institutional investors, engaging in dialogue with companies to influence their policies and practice. This engagement is not merely about the short-term gain but also focuses on long-term value creation and driving meaningful changes. Dialogues and engagement. Dialogue is a cornerstone of CAS. Through constructive discussion, shareholders can address various issues such as environmental, social, and governance practices, corporate strategy, and risk management. This engagement can take many forms, including direct meeting with the company executives, participation in the shareholder meetings, and collaborative efforts with other investors. For instance, through dialogue, investors can encourage companies to adopt more sustainable practices, improve transparency, and enhance accountability. Such interactions are vital in aligning corporate action with broader goals of sustainability and ethical governance. The continuous feedback loop between shareholders and companies ensures that the latter remain attuned to the evolving expectations of their investors and broader society. The next is driving changes. CAS play a significant role in driving corporate changes. Shareholders wield considerable influence and can push for reform that might otherwise be overlooked. They can propose shareholder resolution on critical issues such as climatic change, labor rights, and board diversity. These proposals, even if not always pass, often lead to substantial discussion and incremental changes within the company. The next is related to the long-term value creation. The ultimate aim of CAS is to create long-term value for both companies and their shareholders. By promoting sustainable practice and sound governance, CAS helps companies mitigate risk and seize opportunities in a rapidly changing world. This forward-looking approach ensures that the businesses are not just profitable but are also resilient and adaptable to future challenges. In conclusion, corporate engagement shareholder actions are essential mechanisms for ensure that companies operate responsible and sustainably. By fostering open dialogue and driving meaningful change, shareholders play a crucial role in building a more sustainable and equitable business landscape. Now let us see how ESG integration helps for sustainable investment strategy for India. Largest deployable strategy. In India, ESG integration into investment strategy is gaining significant momentum, driven primarily by large-scale deployment of renewable energy projects. India aims to achieve 500 gigawatts to renewable energy capacity by 2030, that is 2030, reflecting a massive investment opportunity in solar, wind, and hydroelectricity power. The government supportive policy such as taxation, tax incentives and subsidies for green energy projects have attracted both domestic and international investors. For instance, the International Finance Corporation estimates that the climate investment opportunities in India could reach about $3.1 trillion between 2018 and 2030. This largest deployable strategy not only supports the nation's climate goal but also offers long-term financial returns, making it cornerstone of sustainable investment. The next is related to the holistic approach. A holistic approach to ESG integration involves assessing companies based on the wide array of environmental, social, and governance criteria. Investors consider factors such as carbon footprints, resource efficiency, labor practices, diversity, corporate governance, and ethical business conduct. This comprehensive evaluation ensures that investments are not just profitable but also responsible and sustainable. In India, the Security and Exchange Board of India, that is SEBI, mandates the top 1,000 listed companies to disclose their ESG practice, enhancing transparency and accountability. Moreover, Indian companies are increasingly adopting international frameworks like Global Reporting Initiative, that is GRI, and Sustainability Accounting Standard Board, that is SASB, to align their ESG reporting with the global standard. Such a holistic approach helps investors mitigate risk and identify opportunities that contribute to sustainable development. The next is related to how mainstreaming adoption. The mainstreaming adoption of ESG principles in India is being driven by growing awareness among institutional and retail investors about the importance of sustainability. Assets managers and institutional investors are increasingly incorporating ESG criteria into their investment decisions, recognizing the long-term benefit of the sustainable investing. Reports indicate that sustainable investment tends to perform better financial and more resilient to market volatility. Additionally, collaborative initiatives such as Indian Climate Collaborative mobilize resources and expertise to address climate change and promote sustainable development. Technologies advancement like big data analytics and blockchain further enhance the ability to assess and monitor ESG performance, making it easier for investors to adopt these principles. Overall, it seems the integration of ESG factors into investment strategy is becoming a mainstream practice in India. By focusing on large-scale renewable energy projects, adopting a holistic approach to evaluate ESG criteria, and mainstreaming ESG principles, India is positioning itself as a leader in sustainable investment. This slide discusses on impact or community investing, that is ICI. Impact or community investing is an innovative approach to investing that seeks to generate positive social environmental impact alongside financial returns. This investment strategy targets local communities aiming to address specific social issues, promote economic development, and foster sustainability. ICI is distinguished by its focus on measurable impact and adoption of innovative approach to achieve its goal. First is related to the target impact. ICI primarily targets areas with pressing social and environmental needs. These areas may include affordable housing, renewable energy, healthcare, education, and small business development. By directing capital to projects and enterprises that addresses these needs, ICI helps improve the quality of life for undeserved populations. The targeted impact is not only broad-based but also tailored to specific requirements of the communities involved. Next is related to measurable impact. A key characteristic of ICI is its emphasis on measurable impact. Investors and fund managers uses various matrices and frameworks such as Global Impact Investing Network, that is GIIN, and the Impact Reporting and Investment Standards, that is IRIS, to evaluate the social and environment outcomes for their investments. This rigorous approach ensures transparency and accountability, allowing investors to track the effectiveness of their investments and achieving desired outcome. The third is related to local communities. Local communities are the heart of ICI. By investing directly in community-focused projects, ICI helps stimulate local economies, create jobs, and enhance the social cohesion. This investment often supports small business, social enterprises, and community development initiatives that may not have access to traditional funding sources. The localized approach ensures that the benefits of ICI are felt directly by the communities it's aimed to serve. The next is, we can say that this is an innovative approach. ICI is characterized by its innovative approach to solving social and environmental problems. This may involve the use of new financial instruments such as social impact bonds and leveraging the technology to enhance the impact. Additionally, ICI often incorporates stakeholders collaboration, bringing together investors and non-profits and local government to create a holistic solution. In conclusion, impact or the community investing represents a powerful tool for fostering positive change in local communities. By focusing on measurable impact and adopting innovative approach, ICI not only delivers financial returns but also contributes to building more resilient and equitable society. Well, this slide will discuss negative exclusionary screening controversial industries. Negative or exclusionary screening is an investment strategy that excludes companies or industries deemed unethical or harmful. This approach is widely used by socially responsible investors to avoid supporting industries that conflicts with their values. Among the most commonly excluded sector are, first one is tobacco industries. The tobacco industry is frequently excluded due to its significant health impact. Tobacco products are the leading cause of the preventable deaths globally, contributing to various diseases such as cancer, heart diseases, and respiratory illness. By excluding tobacco companies from their portfolio, investors send a powerful message against the health risk associated with the tobacco use. Additionally, avoiding investment in tobaccos aligns with the global health initiatives and promotes a healthier society. Investors also recognize the potential financial risk associated with the regulatory changes, lawsuits, and shifting consumer preference away from tobacco products. Second is related to the gambling industries. The gambling industry is another sector commonly excluded from ethical investment portfolio. Gambling can lead to addiction, financial ruin, and social problems such as crime and family breakdown. By excluding gambling companies, investors aim to reduce the negative social impact associated with gambling addiction and promote the healthier lifestyle. This exclusion aligns with the efforts to support community well-being and social stability. Investors also consider the regulatory risk and potential for increased scrutiny and restrictions on the gambling industries. The last is related to the weapon industries. The weapon industry particularly manufactures for controversial weapons like landmine, cluster bombs, and nuclear weapons is often excluded due to ethical concern. These weapons cause indiscriminate harm and have a long-lasting impact on civilian population. Investors who exclude weapon manufacturing aims to promote peace and security, adhering to international humanitarian law and treaties. By avoiding investment in industries Investors also mitigate the risk associated with the reputational damage and regulatory action, supporting a more stable and peaceful global environment. Overall, negative or exclusionary screening is a powerful tool for socially responsible investors to align their portfolio with their ethical values by excluding controversial industries like tobacco, weapon, and gambling. Investors can avoid supporting harmful practice and contribute to positive social change. This approach not only helps mitigate the ethical and financial risk but also promote a more sustainable and justifiable society. Now we shall discuss just opposite to the previous slide, that is positive or the best in class screening evaluation criteria. The positive or the best in class screening is an investment strategy that selects companies with superior performance in environmental, social, and governance criteria. This approach rewards leaders in sustainability and ethical practice, aiming to promote responsible corporate behavior while achieving strong financial returns. Here are a closer look at the evaluation criteria used in positive screening. First is related to the environmental criteria. The environmental performance is a key aspect of the positive screening. Investors assess companies based on their efforts to minimize environmental impact through sustainable practice. This includes reducing greenhouse gas emission, improving energy efficiency, managing waste, and conserving water. Companies that lead in developing environmentally friendly products, adopting renewable energy sources, and implementing robust environmental management systems are favored. Positive screening also considers a company's commitment to biodiversity and pollution prevention. By investing in environmentally responsible companies, investor contributes to fight against the climate change and environmental degradation. The next is related to the social criteria. Social performance evaluates how company manages relationship with employees, customers, suppliers, and community. Key factors include labor practice, employees diversity and inclusion, human rights, community engagement, and product safety. Companies that foster positive workplace environments ensure fair treatment of workers and contribute to community development are rated highly. Social criteria also involve assessing a company's supply chain practice to ensure they avoid human rights abuse and promote fair labor standards. Positive screening in the social domain supports the creation of equitable and inclusive societies. The next is related to the governance criteria. The governance focuses on corporate leadership, ethical practice, and transparency. Investors look for the company with a strong governance structure, including independent boards, diverse leadership, and effective oversight mechanism. Other considerations include executive compensation, alignment with the performance shareholders' rights, and anti-corruption measures. High governance standards indicate a company commitment to ethical behavior, accountability, and long-term strategic thinking. By prioritizing well-governed companies, investors can mitigate risk associated with the corporate misconduct and enhance overall trust in their investment. Thus, positive or the best-in-class screening is an effective way for investors to support and benefit from leading ESG practices. By focusing on environmental sustainability, social responsibility, and social governance, this approach not only promotes ethical corporate behavior but also drives long-term value creation. Now let us discuss ESG integration, that is risk and opportunities associated with it. Environmental, social, and governance integration have become a crucial aspect of modern investment strategy, reflecting a shift towards the sustainable and responsible investing. ESG integration involves incorporating ESG factor into investment analysis and decision-making process, offering both risk and opportunity for businesses and investors alike. The first is now we shall discuss related to the risk management. ESG integration play a vital role in risk management by considering environmental factors. Companies can mitigate risk related to climate change, resource depletion, and regulatory changes. For instance, businesses that adopt sustainable practice are less likely to face penalties and legal issues, reducing financial and reputational risks. Social factors such as labor practice and community relation also helps in identifying potential risks related to human rights violation and employee dissatisfaction. A strong governance practice ensure transparency, ethical behavior, and compliance with the regulation further minimize risk associated with the corporate misconduct. The next is related to long-term value creation. Investing with an ESG lens fosters long-term value creation. Companies that prioritize ESG factors are better positioned to adapt to evolving market demands and regulatory landscape. Sustainable practice can lead to cost saving through energy efficiency, waste reduction, and improved resource management. Socially responsible companies often enjoy higher employee morale, increased customer loyalty, and stronger brand reputation, contributing to sustained financial performance. Additionally, robust governance framework ensure better decision-making, risk oversight, leading to more resilient business model. The next is competitive advantage. ESG integration offers significant competitive advantage. Companies that excel in ESG performance are more attractive to investors as they are perceived to be more forward-thinking and less prone to crisis. This can lead to a lower cost of capital and enhance access to funding. Moreover, businesses that lead in sustainability can capitalize on new market opportunities such as growing demand for green products and services. They can also benefit from preferential treatment by regulators and policymakers who are increasingly prioritizing sustainability in their agendas. In conclusion, the ESG integration is essential for the modern business seeking to navigate the complexity of today's economic landscape. By managing risk, creating long-term value, and leveraging competitive advantage, companies can achieve sustainable growth. Now let us discuss what are the options available for sustainability theme investing. Sustainability theme investing has emerged as a significant trend in India, presenting numerous opportunities for investors seeking to align their portfolio with the environmental and social goals. India, with its growing economy and pressing environmental challenges, offers promising avenues in sectors such as renewable energy, clean technology, sustainable agriculture, and green building. We will discuss one by one each of them. First is related to renewable energy. India's renewable energy sector is a prime opportunity for sustainability theme investing. With the government's ambitious target of achieving 175 gigawatt of renewable energy capacity by 2022 and 450 gigawatts by 2030, there is a substantial growth potential. Investment in solar, wind, and hydroelectricity power are not only environmentally beneficial but also economically viable, given the declining cost of renewable technologies. Companies leading in renewable energy innovation and infrastructure development are attractive prospects for investors looking to support India's transition to low carbon economy. Next is related to the clean technology. Clean technology encompasses energy efficiency, waste management, and water purification. Present significant investment opportunity. Innovation in this sector can drive substantial environmental benefits and the cost saving. For instance, advancements in battery storage and smart grid technologies are essential for enhancing energy efficiency and reliability. Waste to energy projects and advanced water filtration systems are also critical in addressing India's waste management and water scarcity issue. Investors can capitalize on the growing demand for the substantial solution in this area. The third is the sustainable agriculture. Sustainable agriculture is crucial for India's food security and rural development. Investment in organic farming, precision agriculture, and agroforestry can lead to increased productivity, reduced environmental impact, and improved livelihoods for farmers. Technologies that optimize resource use, such as drip irrigation, soil health monitoring, are essential for sustainable agriculture practice. Companies and projects that promote sustainable agriculture can benefit from rising consumer demand for organic and sustainably produced food. The last is related to the most potential aspect is the green building. The green building sector is expanding rapidly in India, driven by urbanization and the need for energy efficient infrastructure. Investment in green building materials, energy efficient appliances, and sustainable construction practice are gaining traction. Green building reduces energy consumption, lower operating costs, and provide healthier living environment. As awareness and regulatory support for green building grow, this sector offers lucrative opportunities for investors. Overall, it seems that sustainability-themed investing in India offers robust opportunities across renewable energy, clean technology, sustainable agriculture, and green building. By supporting these sectors, investors can contribute to India's sustainable development goal while achieving long-term financial return. This slide discusses the impact investing by measurable outcomes. Impact investing is an investment strategy aimed at generating positive social and environmental outcomes alongside financial returns. This approach is gaining traction as investors increasingly seek to address global challenges through their investment choice. Key areas of focus in impact investing include social impact, environmental impact, and the measurement and reporting of these outcomes. Let us discuss one by one. First is related to the social impact. Impact investing strives to achieve significant social impact by funding projects and enterprises that addresses pressing social issues. These investments often target areas such as education, healthcare, affordable housing, and economic development. For example, impact investment in education can improve access to quality schooling for undeserved communities, leading to better educational outcomes and increased opportunity. Similarly, investments in healthcare can enhance access to medical services, improving overall health and well-being. By channeling funds into the socially benefits projects, impact investors contribute to the betterment of the society and reduces inequality. Next is related to the environmental impact. Environmental impact is another crucial aspect of impact investing. Investors seek to support projects that promote sustainability and mitigate environmental degradation. This includes investments in renewable energy, energy efficiency, waste management, and sustainable agriculture. For instance, funding renewable energy projects such as solar and wind farms help reduce reliance on fossil fuels and decreases greenhouse gas emissions. Investment in sustainable agriculture practice can promote biodiversity, conserve water, and reduce the environmental footprints and food production. Through these initiatives, impact investors play a vital role in addressing environmental challenges and promoting a sustainable future. The next is related to measurement and reporting. Measuring and reporting the outcome of impact investment is essential for ensuring transparency and accountability. Investors use various frameworks and matrices to assess the social and environmental performance of their investment. Commonly used tools include the Global Impact Investing Network, that is GIIN, Impact Reporting and Investment Standard, that is IRIS, and the United Nations Sustainable Development Goals. These framework provides standardized measures for evaluating impact, allowing investors to track progress and demonstrate the effectiveness of their investment. Transparent reporting ensures that impact investors can make informed decisions and continually improve their strategies to achieve better outcomes. In conclusion, today impact investing represents a powerful approach to addressing social and environmental challenges while achieving financial return. By focusing on measurable outcome in social and environmental impact and emphasizing rigorous measurement and reporting, impact investors can drive meaningful changes and contribute to a more equitable and sustainable world. At the end, we shall discuss about the corporate engagement or the shareholder resolutions. Corporate engagement through shareholder resolution is a powerful tool for investors seeking to influence corporate behavior and drive positive changes. This process involves submitting proposal, proxy voting, and actively engaging with the companies to address various issues including environmental, social, and governance practice. Let us see first the proposal of submission. Shareholder resolution typically begins with the submission of a proposal by one or more investors. These proposals can address a wide range of issues such as climate change, human rights, executive compensation, and board diversity. To submit a proposal, shareholder must own a minimum amount of company stock for a specified period. The proposal must be submitted according to the company's guidelines and Security and Exchange Commission, that is SEC rules. Once submitted, the company reviews the proposal and decides whether to include it in the proxy statement for voting at the annual general meeting, that is AGM. Now the next is related to the proxy voting. Proxy voting is a crucial mechanism that allows shareholders to vote on resolution without being physically present at the AGM. Shareholders receive proxy material including information about the proposal and the board's recommendation. They can then cast their votes online by mail or by phone. Proxy advisor often provide analysis and recommendation on how to vote, helping shareholders make informed decisions. The outcome of these votes can significantly impact corporate policies and practice. Even if a resolution does not receive majority support, it can still prompt dialogue and incremental change within the company. The next is related to the driving changes. The shareholder resolution are instrumental in driving changes within companies. When a proposal garners significant support, it sends a strong message to the company's management about the investors' priorities and concerns. Companies are often compelled to engage with shareholders, leading to negotiations and commitment to improve ESG practice. Successful resolution can result in tangible changes such as enhanced sustainability reporting, improved labor practice, and greater transparency in corporate governance. Even proposals that do not pass can raise awareness and influence corporate behavior over time. Overall, it seems that the corporate engagement through stakeholder resolution is an effective strategy for investors to advocate for responsible businesses practice and sustainable growth. By submitting proposals, participating in proxy voting, and driving meaningful changes, the shareholders can hold companies accountable and promote long-term value creation. As we conclude our presentation, we'd like to leave you with some key takeaways. Today we explored sustainable investment strategy including norm-based screening with national standards, negative or exclusionary screening, positive or the best-in-class screening, and corporate engagement and shareholder action. We also highlighted impact or community investing, ESG integration with risk and opportunities, sustainability theme investing and their opportunities, impact investing and measurable outcomes, and corporate engagement with shareholder resolutions. Looking ahead, we delve into sustainable investment option available in India. So, join us next week as we explore available option for sustainable investment in India. Until then, we wish you the best of luck and stay safe.